All right, let's dive a little bit deeper into the action with our markets reporters. Abigail, what are you watching?
You know, Romaine, I'm thinking about the quarter that was, the third quarter. You called it wacky earlier. I would have to agree. This chart may actually suggest it's also slightly risk off. We've looked at this chart before. It's a quarterly chart. What we're looking at here in yellow is gold, white Treasury futures. So those are actually bonds. In purple, we're looking at the E-mini futures, and in blue, the NASDAQ 100 futures. We see that the major divergence point back when the Fed lowered rates back on July 31st, gold shot higher, Treasuries took off, stocks went lower. Well, that dynamic is pretty much in play. Gold is higher, Treasuries higher, outperforming both the S&P 500 and the NASDAQ 100. Take a look at those NASDAQ 100 futures, down about 0.5% on the quarter. The first down quarter of the year. When you have divergences like that amongst risk assets, you really want to think about it, especially considering last September, Sarah, we had the NASDAQ put up its first monthly down quarter in a long time. And that, of course, was ahead of all of that volatility, Sarah.
Thanks, Abigail. Well, I want to continue with the quarter that was, because it really was quite hectic between Fed rate cuts and inverted yield curves, spikes in the oil market, also dislocations in the repo market. But when you put it all together, here is your scorecard for U.S. equities. Really defensives just taking off at the top of the chart. As you can see right here, utilities up more than 8%, then real estate, staples, and then technology. At the bottom, you have your more cyclical areas of the market like energy, materials, healthcare continue to be hated or disliked as well. And I do want to point out with utilities, not only were utilities the best performing sector this quarter, utilities have actually been higher now for 6 straight quarters, and that is the longest winning streak since 1999. So it shows you just how stretched this defensive trade has become. I spoke with the chief investment strategist at Northwestern Mutual Asset Management earlier today, and he warned that these trades can be like rubber bands. They get stretched and stretched and stretched until one day they maybe snap. Renita.
Thanks, Sarah. I'll round it up with a look at crude oil. WTI is down now more than 3% and for the second straight quarter, as fears of a global economic slowdown overshadow those unprecedented attacks on Saudi Arabia's energy infrastructure. Oil has given up all of its gains following those attacks, and Saudi Aramco says it's fully restored output, producing more than 9.9 million barrels a day now. In fact, an Aramco official says output was a little bit higher now, and this has happened way quicker than